You may have heard about a recent news story concerning a man named Billy Rowland. He was a successful businessman, a dedicated community member, and by all accounts, a wonderful grandpa. But after he passed away, his heirs were hit with a $1.5 million extra estate tax bill. This happened because of a mistake made years earlier on his late wife's estate tax return. This story is a powerful reminder of something called portability. This is a fantastic provision in the tax code that allows a surviving spouse to use a leftover estate tax exclusion from their deceased spouse. Right now, the exclusion is quite generous, $13.99 million per person for 2025. This means a married couple can essentially have a combined exclusion of almost $28 million. The Rowland case highlights a critical point. This benefit isn't automatic. To get it, the executor of the first spouse to die must file an estate tax return and fill it out correctly, even if the estate isn't large enough to owe any taxes at that time. The biggest lesson here is that you can't just assume everything is in order. Just because your family's assets are below the current estate tax threshold doesn't mean you should skip filing the estate tax when the first spouse dies. Estate planning isn't something to be done in isolation. It's a critical conversation for married couples to have together. The fees for an experienced lawyer or an accountant to properly file an estate tax return are a drop in the bucket compared to the millions in taxes that can be lost later. Remember, the current generous estate tax exclusion is scheduled to decrease significantly at the end of 2025. This makes the portability election even more important for many more families who might not have been concerned before.